2024 was a blockbuster year for the options market. Average daily trading volume climbed another 9.7% to a record 48.5 million contracts. Equity options activity led the way, up 16% year over year. And along with that explosion in volume has come a surge in new traders and new products. A recent Moomoo CBOE joint survey found 2/3 of respondents have been trading options for 3 years or less. 38% started in the last year. So what does it all mean for today's options traders? What opportunities and risks does the explosion in activity and participation create? I've brought another all-new guest on the MoneyShow MoneyMasters Podcast to get you those answers. He's Mark Longo, founder and CEO of the Options Insider Media Group. Mark, thanks for joining me.
Thanks for having me.
Yeah, this is great. I'm glad we're able to connect here, especially ahead of the Las Vegas show you're going to be joining us for. This is the first time I've had you on the podcast. So just in case some of our listeners aren't familiar with you or your background, why don't you just share a few details about that first?
Sure. Yeah, I've been in the options game for a while. I started as a market maker down on the CBOE. So I was a member of the CBOE for a number of years. I made markets in products like SPX, so the S&P 500 options. And then when all of this, the big multiple listing battle happened, in the early days of equity options there, at least for the exchanges fighting for them, I went out into Intel and Microsoft and made markets out there. These were wild times. People were getting into fights every day to get into the new pits. People were sleeping over at the exchange to get the first spot the next morning. It was wild time. So that was my start. And then around, in fact, just it's funny you asked this today because just on the 18th, so just the 27th. So just a day ago, we had our 18-year anniversary, actually. So we launched the first options podcast. We launched this whole options insider thing back on January 27th of 2007. So wild times. It's been
great milestone.
Yeah, 18 years. We started at the time. I was writing some columns while even back then it was clear the market making trajectory wasn't long for this world. The risk was going up, the margins were going down. Those two graphs were not moving in the right trajectory. So I was looking at other things to do on the side. I got roped into doing some columns for some big publications at the time, Traders Magazine, financial magazines, others. They wanted to get into options trading a little more. So I started on this as a fun hobby, writing some columns for them about options trading in the industry. And that took off. And unbeknownst to me, there was clearly a huge demand for options content from people who had a background in the options market. So that's where we came up with the name Options Insider. Everyone we work with and produces content for us all has some background in the world of options. And we launched the website back in 2007. And also at the time, we were experimenting with how can we get other people into options? Let's try some new forms of media. And that's where podcasting came along. This is pre-iPhone. You had to have an RSS reader to get it. So it was pretty early days. We had a very hardcore audience back in the early days because you had to really jump through a lot of hoops to get it. But we launched at the time what was the first ever options podcast. And now 18 years later, it's grown into this enormous network, over a dozen shows. It's been listened to all over the globe, millions of downloads. It's kind of fascinating too. So if you had told me when I was standing out in the SPX that my career trajectory would morph into this, content side of the business, I would have said you were crazy because it didn't exist back then. But it's been a fun ride nonetheless.
I'm glad to hear it. And again, congratulations on your longevity in a business that doesn't typically have a lot of that, depending on the practitioners and the speakers that you talk to.
You must be doing something right to still be here 18 years later.
Absolutely. Let's talk about how the market itself has changed during that time in terms of the options market. And obviously some of the functionality and the way things happen behind the scenes, yes. But for today's trader, I mean, what are some of the things that when you are educating your listeners and people kind of stop you on the street, so to speak, what are you telling them now that you might not have told them, or that's changed, versus 10, 15, 20 years ago?
I would say the overall baseline level of your new options trader is markedly higher than it was 10, 15 years ago. When I walked on the floor of the CBOE, we had tools back then that were strictly the domain of the professional, things like volatility skew charts and all this type of analysis we would do. And now, even on some of our very basic programming, when we have shows that are out there for the very basic educational content, what's a call, what's a put, type of programming. New listeners to those programs already coming in, and they're already asking those types of questions. What about the skew graph here? And what about, so the level of sophistication, I would say, has leapt several orders of magnitude in the last, let's say, 10, 15 years. Some of that is aided by the prevalence of content. Obviously, our stuff is out there, but there's a lot of options content out there now. Yeah. Also, the brokers are doing a lot of heavy lifting on the educational front, and also the availability of those pro level tools. These things just didn't exist when I was a market maker. You had to call up for a lot of your options trades still then. And, fast forward to today, everything's online. All of those advanced tools like skew charts and everything else are all available at the click of a button on most major platforms now. So even if you come in and you open an account with a very small amount of money, you have access to these pro level tools. So in general, all of that is kind of raising the overall level of your average or introductory options trade. So that's been a great thing to see, because we are seeing, as you mentioned, so many new people come into the space. Someone made a joke on my network a year or two ago, and I borrowed it ever since. We've been saying for a long time we wanted new people to come into the options market. We didn't know they were all going to come at once. And that's what happened after the pandemic. It's been this mad just tsunami of people invading the option, which is fantastic. It's great for businesses like mine, but it's also caused the overall level of just wherewithal. People know what options are now as opposed to 10, 15 years ago. I was in college. I had to take a specialized course to learn about derivatives. It was in the graduate school. I had to go take a special graduate school course as an undergrad just because I wanted to learn about derivatives. That's how the lengths you had to go to. These days, you can go read a Reddit forum. It's not going to be that accurate, but it's available there. Kids, young kids, college kids, even younger, are talking about options. They know what these things are. And the nice thing is, too, for someone who's been in the options game for a while, it's not all negative. For a long time, options only came to the forefront. They were only mentioned in the mainstream media when things were bad. Long-term capital blowing up, the Orange County disaster, Barings and Nick Leeson, which kind of got me into the game, actually, that big scandal. It was always one big scandal after another that drove people to the options market. These days, the outlook, the coverage, the viewpoint of options is much more nuanced. It's much more, much more in-depth. People don't just view them as risk additive instruments these days. They view them the way they're supposed to be. They're risk mitigating instruments when used when used properly. So yeah, it's been fascinating to watch all that evolution. We can probably do 2 hours on that, but we don't have that much time today.
Yeah, I have to ask, some of these new products, zero DTE options obviously are talked about all the time. Not that you couldn't used to trade a long-term option in the last day or two, that it was still on the board. But we've gone from monthlies to weeklies to dailies, a lot more options on underlying investments and so on that you might not be able to access a while ago. What are your thoughts on that trend? Benefits and drawbacks, I guess.
The zero DTE revolution, as I kind of call it now, it kicked off in April of 2022. So we're coming up on the 3-year anniversary this April. And I'll admit, when the news was announced, when, SIBO and CME announced the news, it wasn't a big deal. No one really paid much attention to it. I certainly didn't. They already had Monday, Wednesday, and Friday expirations. They were just finishing up the cycle. They were adding Tuesday and Thursday. Seemed like a logical thing. The news, when it came out, kind of got swept under the rug. We talked about it maybe a little bit with some of our guests, but no one, even people in the exchange space, no one was particularly excited about it. It was like, here, we're just doing this because we feel like we have to do it to complete the product offering. And lo and behold, that little seemingly insignificant launch of these products, because you're right, trading on the day of expiration had existed since time immemorial in the option space. When I first started in the world of options, you were trained to avoid that. You trained to close all your positions. You didn't want to have anything going on the day of expiration, because that's when things got wild. That's when gamma exploded, theta exploded. All of your models broke down. Nothing could model things accurately. So the smart people got the hell out of Dodge on expiration day. Now fast forward a few years, and all of a sudden people are rushing towards it. All they want to do is trade expiration day. So that's been kind of wild to me to watch the uptake on those products. And looking now, if you take the numbers any given day, let's go take SPX, for example, a big, enormous, institutionally oriented product.
Yeah.
At any given day, roughly half of the volume in SPX is zero DTE contracts now. That's how much zero DTE has changed the game. It's transformed what people are trading. If I run the top 20 in SPX right now, I would wager heavily to you that all of the top 20 would be expiring today contract. That's how much SPX has changed, which also shows you that it's not just mom and pop 10 lots doing this. It's large funds, it's institutions who have migrated to this 0-day phenomenon. And it's still kind of wild to me. You know, the jury is still out on whether these things are, when they first were announced, we jokingly referred to them as gamma bombs, just waiting to explode in the market at some time. You can't use that. That's TM, by the way. I'm just kidding. But it's a fun name. And it was only half jokingly, because the data was still out on whether trading so many things so close to expiration, such high gamma contracts, whether that would have an impact on the overall risk of the market. We have seen since then, August 5th, the market sold off. Zero DTE volume dropped dramatically that day, which was not surprising to me. No one wants to trade crazy high gamma contracts when everything is melting down around your ears. But other than that, the market survived. We did survive. So maybe some of those concerns were a little overblown early on. There's also some data to show that market makers are using them now to hedge their risks intraday in some interesting and nuanced ways. So maybe they're risk mitigating from that perspective. But I would say in general, myself, and I don't really know anyone in the world of options who thought these would become the transformative product that they are today, let alone taking over massive institutional products like SPX. That's the world we're living in now, 2.5 years later or so. It's all 0-day all the time. We're seeing other exchanges, other products follow suit. Even CME, let's see, on the futures options side, they're starting to add much more near-dated contracts, not just in the equities, but going out into things like natural gas and things that you never would think would be suited to very near-dated liquidity, but that's just where the market is going. So it's been fascinating to watch. I will point this out for your listeners. I know someone watching this is going to say, what about, SPX is fine, but what about Nvidia? What about Tesla? What about getting 0-day options in those? And I would probably pump the brakes for a lot of your listeners and watchers on that, just because everyone I'm talking to behind the scenes who has to deal with the behind the scenes minutia, and there's a lot for these contracts to list something like 0-day Nvidia, 0-day Tesla. It doesn't seem like it's going to happen anytime soon. Equity options in particular, obviously, are physically settled. What that means is they settle into cash, or excuse me, they settle into stock, whereas index options settle into cash. So they pose challenges that index options do not. So a lot of market makers, they like to use what are called contra exercise orders. At the end of the day, you have a contract that's going in the money. You don't want it to be exercised for a variety of reasons. You can issue those. Those take a few hours to settle out at the end of the day. And that would cause a lot of problems for, let's say, a cash, or I should say, I keep saying cash settle, physically settled option like an Nvidia or a Tesla, because obviously you have stock flying left and right all over the place. And so the industry is a little concerned about clearing and dealing with that risk. So there's either they're going to have to get rid of that contra exercise, which a lot of the market makers don't want. That would be a problem from a risk management perspective for them. Or you have to create a whole new suite of cash settled equity options that could have 0-day. So then you have a cash settled Nvidia, a cash settled Tesla, which causes its own problems. There's an educational lift there. People think they're trading an option that settles into stock when it actually doesn't. So there's no good solution yet. So I would say everyone who's excited coming into 2025, I hate to be the bearer of bad news, but if you're excited to see your 0-day Tesla and your 0-day Nvidia, probably going to be a little while. I would say probably not this year, if I had to.
A lot of layers to that onion. I see once you start once you start getting into it. You mentioned a couple of those names. I have to ask, just, given what's going on in the market, Nvidia, obviously, and some of those other sort of companies and stocks in that same universe. What's going on out there, and what are your thoughts on sort of what this says, if anything, about volatility or opportunity in the tech sector, which everybody is really high on?
It's interesting. I've been saying for a while on our network that this market has been whistling past the graveyard on the backs of a couple of things. It's first off, it's this expectation that the Fed's going to be aggressively cutting rates. We've all seen how that's played out. They've cut rates a few times, but nowhere near the aggressive schedule that a lot of the market and a lot of the bulls really wanted. And then also the other side of this was AI. AI was going to be the panacea for all the ills, not just of the market, but of society. And so we were seeing a lot of these big names being carried aloft to extremely lofty PEs, extremely lofty valuations on the backs of the, assumptions that every firm is going to have to continue spending enormous amounts of capital to get into the AI game, and that some of these early movers in the AI space had insurmountable advantages that no other firm could catch up to without spending, again, inordinate amounts of money. And then lo and behold, we have this DeepSeek come out this week, which kind of undercuts all of those assumptions. You don't need to spend a lot of money. There isn't an insurmountable barrier around these other names that were first movers in the space. So I'm not surprised to see some big names like Nvidia take, the largest market cap hit ever in the history of the market in one day on the backs of that, because some of these long held assumptions that have been carrying the market aloft are now starting to be called into question. Again, it's only one day. You don't want to read too deep into it, and people haven't really jumped too deeply into this new model yet to see if it really is competitive with Chat GPT. But just the fact that it exists, and if their claims are true that it was built on for such low cost, and little genius moves too, like there's export bans on these chips to China, so they went and used AWS. It's genius. You can rent the chips from Amazon instead. No export restrictions there. Someone forgot about that little loophole in the export restrictions. But interesting thing. So I wasn't surprised at all to see that move we saw yesterday, and I wouldn't say explosion in vol, but the fact that vol got a little bit more, let's say, spicy as a result, because that's I would say, really the key thing that's been holding up this market for some time. People have been joking for how long now? It's Nvidia's market, right? We all just live in it. Forget about the Fed announcements. It's really about what Nvidia says quarter after quarter. So the fact that now some of that could be undercut. I mean, Nvidia was trading 150 not that long ago, a couple of weeks ago. It was threatening 100. So, it's interesting to see how much that could move. And in fact, it's funny you asked that, because we actually asked that to our audience just this week as well, because our audience usually pretty prescient on these topics.
Yeah.
We asked them, we said, is DeepSeek, is this a canary in the coal mine for the end of the AI boom? And we asked them two questions. Do you think the S&P will close positive on the year, and will Nvidia close positive on the year as a result? It was interesting bifurcated results. 56% said no, the S&P will not close positive on the year. So they're very bearish on the S&P, but still 63% said Nvidia will close positive on the year. I'm not sure how those two things go hand in hand. You think one going down would suck the other away, but that does lead to the overall kind of general bearish sentiment we've been hearing from a lot of folks coming into this year, that can these massive multiples that we've been trading at for so long, can they continue to be maintained? Can we continue to keep these levels out there? Will something else come to pass? We also do an annual poll of the sentiment of our audience for where they feel volatility will be at the end of the year, aka where will VIX close at the end of the year. And over a third of our audience thought VIX will be north of 20 at the end of the year, which is usually a seasonally quiet time. So there are a lot of people out there who are baking in some vol into this year, which is interesting, because this year is really missing a lot of the obvious catalysts that we had last year. For example, last year, obvious vol catalyst was the election. What was going to happen going into that, coming out of that? So that kept vol, that kept the VIX futures elevated heading into Q3 and Q4. We don't have those obvious catalysts this year. So it's very much a trader's market this year, and keeping an eye on what's going on in developments like this, how this changes the perceptions in the market going forward. I will say on the subject of volatility, we are heading into the big earnings week this week. Earnings and volatility are very much go hand in hand. And we've been crunching the data on earnings volatility for quite some time, quite simply because no one else was doing it. And we kept getting asked these questions by listeners day in, day out. How should I trade earnings? Should I buy vol going into earnings? Should I sell vol? And there really was no data. So I would say at least 5 years ago, maybe a little longer now, we started crunching all that data. We put it out on our website completely for free. So if our listeners are intrigued, or the viewers of this are intrigued, and they want to go crunch the numbers for, let's say, Nvidia, how it's performed in the past and what it's pricing in right now, we have all that available on the website for them, all for free, because we just thought it was a useful service for the market. And it's been an interesting time to be crunching that data, obviously going through the pandemic when earnings vol went to die. Nobody cared about earnings volatility, and the returns for buying vol were terrible. And interesting enough, going into this year, and then I'd say the last couple of years, when anyone asked us that question, how should we approach earnings vol, we would typically say, avoid it because it's a crapshoot. It's a coin flip, 50-50. The long vol wins roughly half the time, short vol wins roughly half the time. And you want to avoid that in your trading if whenever possible. That said, this past year and change has really been one of the few times that since we've been crunching the number where the data has become biased really in one direction, which is long vol. These names are outperforming from an earnings volatility perspective, cycle after cycle, and dramatically so. 14, 15% a cycle. Our long-term average, which is tracking all the data we've been crunching since we've been doing this, is up around 114% right now, which means that if every name in the market that reports earnings, if they all moved exactly as much as their straddle was predicting. And I don't want to get too deep into the terminology for some of your listeners who maybe aren't that well versed in options, but they're at the money straddle. If they all moved exactly what the options market was predicting, that would be 100%. So we're at 114 right now, which means they're outperforming by 14%, which is enormous. We've never seen that before. So it's just something to bear in mind. I don't want the watchers this to go out and just start willy-nilly buying premium going into earnings announcement. It's something to be cognizant of, though, going into this cycle, because we've been waiting for a while for this trend to turn around. And so far, it hasn't yet. Maybe this cycle. Thing. Oh, good.
I say it's an interesting thing to highlight. I actually haven't heard that discussed very often, so that's
because no one crunches that data really, except for us. So it's kind of fascinating because it's such a low-hanging fruit options question. I think most people would want to know that, and yet for whatever reason, no one talks about, no one crunches that data. So we started doing it a while ago, and it's been fascinating to watch. So at the very least, if you're a premium seller going into earnings season, maybe be a little bit judicial with how you blast away hitting those bids, because everything is outperforming to the upside from a vol perspective these days. So again, something to bear in mind. We haven't seen it like this before. It's never been a case in the past where I've been willing to recommend go long premium, but in aggregate right now, that trade has been winning. So it's kind of wild to see that. How long that will continue to persist. It can't persist forever. It has to revert back to the mean, to the norm eventually. But for we've been saying it's going to revert for over the last year, roughly year and a half, and it hasn't yet. So that's been a fascinating trend in and of itself.
Well, Mark, I'd love to keep talking forever, but one of the reasons I have you on, and it's great that you're going to be joining us for the 25 Money Show Traders Expo in Las Vegas next month. People are going to have a chance to kind of hear from you in person and ask you questions there on site. So I want to briefly touch, though, on your topic, which is the top 5 options trading mistakes and how to avoid them, without giving away too much, because, of course, I'd love for them to join us.
Come to Vegas.
Maybe a sneak peek at what you're going to be talking about there.
They have to come to Vegas to hear the whole thing. But, like I said, I've been doing this for a while in the options insider alone for now 18 years, which is, again, wild to say out loud when you hear it that way. But along that time, I've seen a lot of new entrants to the options market. And it seems like time and again, they make the same mistakes over and over and over again. And they could be costly, obviously, just financially. And also they could be a disincentive to new options traders. They say, oh, this options market, this is terrible. These products suck. I'm going to trade something else. And they go away and they don't come back. And so that's been a pattern that's been repeated over time as well, which is another good thing to see. Just going back really quickly to what you were talking about with the explosion of options volume. That's a pattern we haven't seen repeated now. People are coming into the options market and they're staying, which is great to see, which means hopefully they're not making some of these new mistakes. But these are mistakes we've seen for a long time. I boil them down to 5. It could probably be a lot more, but I boil them down to a concise 5. Explain how they work, how you can avoid them in your own trading. So that should hopefully have some demonstrable benefit to your trading. And we also sneak in some fun, quick tips and ways you could maybe go the opposite way of these mistakes and use them to improve your trading. So there's a lot of fun things. We're going to cram a lot into roughly 45, 50 minutes there. So it should be a fun one. I hope to see all the folks showing up in Vegas.
Well, that's great, Mark. I really do appreciate you taking some time out, share some of your insights here. Viewers, if you're watching this and you want to learn more from Mark, he is going to be speaking at that event. It's the Money Show Traders Expo Las Vegas. We run February 17th to 19th in the Paris, Las Vegas. You'll find details in the description below, where you can also click the link to register. Mark, great talking with you, and good to see you in about, 3.5 weeks or so.
Yeah, I'll see you in Vegas, and I look forward to seeing all of you viewers there as well.
Sounds good. Take care.